Welcome to the data dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story. And welcome back to the deep dive. Really glad you could join us. As always, we're going to grab that pile of sources you sent over, articles, research, those really detailed interviews, and just pull out the absolute core insights.
Yep.
Today, it's a pretty interesting mix, actually. We're going to look at some specific market data, get into some, pretty crucial economic viewpoints on these huge trends, and then zoom right in on one company making some really big strategic moves.
That's the plan. Our job today, really, is to cut through all the noise, find those key nuggets of information, figure out what they actually mean in the bigger picture, and probably most importantly, connect the dots between all these different pieces.
Right.
The idea is to give you, the listener, that shortcut, and to get you properly informed on these things, maybe with a few surprising facts thrown in, enough detail so it makes sense, without getting totally lost in the weeds. We're basically your guides through this material.
Okay, sounds good. Let's unpack this then, and maybe start with the digital frontier, Bitcoin specifically. You shared this visual, this BTC liquidation heat map. It looks kind of like a weather map for crypto traders using leverage. What exactly is this map showing us about Bitcoin's price, especially over the last 24 hours that this chart covers?
Yeah, it's a fascinating tool. What this heat map does is it gives us a window into the collective sentiment and like the positioning of traders who are using leverage across a bunch of different crypto exchanges.
Okay.
It pulls together data on where margin calls, those forced closures of leverage trading positions where they're predicted to happen.
Yeah.
Basically, it highlights the specific price levels where if Bitcoin hits that price, a significant chunk of these leverage positions would likely get closed out automatically.
So looking at the map itself, the visual, what do the colors and the bands mean?
Right, so you see these horizontal bands across the price chart. Each one lines up with a specific Bitcoin price level. And the color, the intensity, tells you about the density, the concentration of those predicted liquidations at that particular price. Think of it like purple is lower concentration, and as it gets brighter, moving towards yellow, that means it's more concentrated.
So yellow is where the most action is expected.
Exactly. Those yellow zones are where a really large number of leverage positions are kind of clustered together, really vulnerable if the price moves sharply against them.
And how do actual traders use something like this? And what's the practical application?
Well, mainly, they use it to spot potential areas where the market might react strongly. So first, these high-density zones, the yellow ones, they can sometimes act like magnets.
Magnets. How so?
Well, if the price starts moving towards one of these zones and it triggers some liquidations, that can create a cascade. One closing pushes the price, which triggers more closings, and it can sort of pull the price towards the area with the most concentrated liquidations.
Okay, that makes sense. Like a snowball effect.
Kind of, yeah. And second, these clusters of potential liquidations, they represent big pockets of liquidity. So large traders, the whales or smart money, they might use these areas where lots of orders are waiting to get triggered. They use them to get in or out of their own large positions more easily without moving the price too much against themselves initially.
Okay, so that's like a place they can execute big trades.
Right. And when those big orders hit these liquidity pools, it can often cause the price trend to pause or even reverse. So they act as potential support or resistance levels too, just because of the sheer volume of orders clustered there.
Got it. So looking at the specific heat map you sent us, the one covering the last 24 hours, which price levels really stand out as these magnet zones or high-density spots?
Yeah, on this particular chart, the 24-hour view, the most obvious things are those bright yellow bands. They show the highest concentration. We see a pretty notable cluster starting right around the $106,000 mark.
Okay, 106K.
Then moving up, there are some heavier density areas, kind of visible between roughly $107,000 and $108,000. But the absolute highest density zones, the brightest yellow bits on this map, they're clearly higher up. They seem to span from about $110,000 up to maybe $111,000. Those are the levels with the most leveraged positions really stacked up, at least according to this 24-hour snapshot.
And you mentioned there's usually a disclaimer or some context needed with these things.
Oh, absolutely. And it's important here. The source itself points out that the heat map shows where liquidations might start, but not necessarily how far a cascade might go or where the price will eventually stop.
Right. It's not a crystal ball.
Exactly. And the densities shown are relative to each other just within this specific 24-hour window. The tool might have other filters, maybe longer time frames, but this view gives us that immediate picture of where that concentrated leverage is sitting right now.
It's interesting then looking at the chart where the price is currently, or at least where it was towards the end of that 24-hour period. It looks like it dipped below $106,000, even moving towards $104,000 for a bit.
Yeah, that's a key observation.
So, given those high-density liquidation zones are all above 106K, what does the recent price action tell us? What should traders maybe be thinking about?
Well, it tells us that the major pockets of aggregated leveraged liquidity in this specific time frame are sitting significantly above where the price has recently been trading. Those levels, 106K, the 107, 108K range, and especially that 110, 11K zone, they represent potential upside targets if Bitcoin were to turn around and move up with some real momentum.
So, potential magnets if price goes up.
Potentially, yes. Price could get drawn toward those areas, especially if initial buying triggers some of those liquidations, starting a cascade.
Mm-hmm.
But conversely, if price tries to rally and then stalls out before reaching those high-density zones, that could signal that there just isn't enough buying pressure to chew through all the selling that would come from those forced closures. The fact that the price recently dipped below 106K means the market, at least temporarily, moved away from the immediate gravitational pull of those upper liquidation clusters. So based purely on this 21st-hour heat map, the main areas of interest flagged by leverage are currently sitting overhead.
Got it. Let's pivot now quite dramatically from crypto charts to, well, a topic that's just everywhere, artificial intelligence, AI, and its potential, massive impact on jobs. You shared some clips and summaries from Yahoo Finance interviews that really got into this. What were the main points coming out of that coverage?
Yeah, those discussions really highlighted how AI is moving super fast from just being like a cool idea to something being actively implemented across industries. A big point that came up was this Wall Street Journal report about Meta.
Facebook's parent company.
Right. Apparently, they have this really ambitious plan to fully automate their advertising operations using AI, and the timeline was striking by the end of next year.
Wow, that's soon for something that
It
big.
is, and it's a concrete example from a major player. But the conversation went way beyond just Meta. There was a lot of talk around this prediction from the CEO of Anthropic. They're a big AI company. He apparently suggested that AI could potentially wipe out, get this, 50% of entry-level white-collar jobs within the next 5 years.
50% of entry-level white-collar jobs in
Yeah.
just 5 years. That sounds
Uh,
huge, almost
The
unbelievable.
staggering number, yeah. And that figure really became a focal point for the experts discussing it.
So did the experts in those interviews actually agree with that? Did they think that 50% number was realistic?
Well, this is where you saw some definite nuances and maybe disagreements in perspective, which is important, right? You had Darrell West from the Brookings Institution.
Okay, a policy expert.
Yeah, and he seemed to largely agree that, yes, substantial job losses are probably coming. He pointed to things we're already seeing, automation hitting entry-level jobs, administrative tasks, but he also dropped this really surprising stat. He said 40% of recent tech layoffs were actually coders.
Coders, but aren't they supposed to be the high-skilled ones building this stuff?
You'd think. But his point was it challenges that idea that even highly skilled software jobs are totally safe if the task is somewhat repetitive or can be learned by AI. So West seemed more aligned with the potential for really widespread disruption, maybe even significant displacement.
Okay, so he was leaning towards, yes, this is serious. What about the other perspectives?
Then you had Stephanie, another voice in the discussion. She acknowledged the disruption, for sure, but seemed maybe a bit more skeptical about hitting that specific 50% number, resulting in persistently high unemployment. She mentioned that if West's interpretation implied something like a sustained 20% overall unemployment rate, well, she called that seriously disruptive and recessionary.
Implying she didn't necessarily think it would settle there.
It seemed that way.
Yeah.
Like, she recognized AI's power, but perhaps didn't fully buy into the idea that the economy would just sit with that level of unemployment long term. So you had agreement on disruption, but definitely different takes on the scale and the lasting economic impact of the job losses.
Okay, this is where it gets really fascinating for me. We've seen this before, right? Technological shifts,
Yeah.
the Industrial Revolution, the internet. They killed some jobs, sure, but they also created entirely new industries, new roles. Is AI expected to do the same? And crucially, will the new jobs match the skills of the people whose jobs are lost?
That is the critical question, and they really zeroed in on it. One expert called it the mismatch problem.
The mismatch problem. Okay.
So, yes, the consensus is that new jobs will absolutely be created. You'll need people to design, build, train, maintain, manage these AI systems. You'll need people to analyze the outputs, to integrate AI into workflows. maybe entirely new job categories we can't even imagine right now.
Okay, so jobs will be created. But
But, and this is the huge but, the skills needed for those new jobs. They're often fundamentally different from the skills used in, say, the routine administrative tasks, or maybe even some of the basic coding or financial transaction jobs that AI is getting really good at automating.
so you lose a data entry clerk, but you need an AI ethics auditor or a prompt engineer. Very different skills.
Exactly. It creates this massive skills gap. And the overwhelming agreement among the experts was that this puts enormous pressure on the need for job retraining and upskilling programs, like massive society-wide efforts. Without really aggressive, really effective retraining, you end up with this situation where people are displaced, the economy actually needs workers for these new roles, but the available workforce doesn't have the right skills. It's a fundamental disconnect.
That sounds like a huge societal challenge. Stepping back a bit, what about the overall economy? Does adding all this AI make things more expensive inflationary or less expensive disinflationary? Seems like you could argue it both ways.
You definitely can, and that was another point of discussion, even some debate. The argument for AI being potentially inflationary, at least in the near term, focuses on the huge investment needed.
Building all the AI infrastructure.
Right. You need specialized chips, massive data centers, tons of energy. All that requires enormous capital investment and resources, which can push up costs for those inputs.
Okay, so investment drives inflation. What's the other side?
The argument for AI being disinflationary mainly centers on the job losses we just talked about. If AI automation leads to widespread job displacement, fewer people have income, which reduces overall consumer demand.
Less demand pulls prices down.
Exactly. And it also puts downward pressure on wages for many remaining jobs, as the supply of workers potentially outstrips demand in certain areas. Both of those are disinflationary forces.
So which way did the experts lean?
Darrell West seemed to suggest that, regardless of the net inflation effect, the workers themselves are likely to end up in a weaker bargaining position. He pointed back to that potential 10–20% unemployment rate as something that would just significantly erode wage power.
Okay.
Stephanie, though, she brought up the historical perspective. Usually, she argued, technological disruption ultimately boosts overall economic productivity, and higher productivity is generally disinflationary in the long run. She also had an interesting take. She saw AI as potentially helping to rebalance the economy, given that we already have labor supply shortages in some sectors. Maybe AI could help fill some of those gaps, not just eliminate jobs.
That's interesting. She mentioned labor supply issues. Often that connects to discussions about things like immigration or aging populations. Could AI actually step in and be a solution if we have fewer workers in certain areas?
They tackled that directly, but again highlighted the mismatch. Darrell West really emphasized that AI, right now, is mostly impacting white-collar professional tasks, coding, analysis, admin.
Right.
The jobs often discussed in the context of labor shortages or immigration debates are frequently in blue-collar sectors, think construction, hospitality, retail, agriculture. Those jobs still mostly need a physical human present, and the skills are very different from what AI currently excels at.
So AI can't really pour concrete or wait tables yet.
Not effectively, no. So while AI might help if you need more digital assistants or data analysts, it doesn't directly solve a shortage of electricians or home health aides. Stephanie seemed to acknowledge that current mismatch, but maybe held out hope that over time, through retraining and economic shifts, some kind of rebalancing could happen. But it wouldn't be a simple plug-and-play solution.
Okay, this is crucial practical advice. For anyone listening, maybe you're choosing a college major or thinking about a career change. What specific types of jobs or sectors did the interviews suggest are most at risk from AI, and which ones might be safer or even get a boost?
The clearest message was, jobs heavy on repetitive, predictable tasks are the most vulnerable. They specifically called out areas like basic coding, financial transaction processing, a lot of standard administrative work.
Routine stuff.
Pretty much. But, and this is key, they stressed it's not just entry level. They gave the example of radiologists.
You're reading x-rays, MRIs.
Exactly. Highly trained professionals, but the core task involves pattern recognition on images, something AI is getting incredibly good at. So even specialized roles could be at risk if the work is primarily analytical and follows set patterns. Accounting was another field mentioned with lots of automatable tasks.
Okay, so what's safer then?
Jobs that require more creativity, complex strategic thinking, deep interpersonal skills, managing people, tasks that have less uniformity and require adapting to novel situations, those are harder for AI to replicate.
Makes sense.
But ultimately, the argument was that AI is going to touch virtually every sector. So the real key for your future career isn't necessarily finding a field AI won't touch, because that might be impossible, but learning how to use AI tools effectively within your field.
Becoming AI augmented, not AI replaced.
Precisely. That, like in education, they suggested students shouldn't be banned from using AI, but taught how to leverage it for research, for drafting, for analysis, to become more productive with the tool.
Given the scale of this potential disruption, is there anything governments can do? Can they regulate this, manage the transition somehow?
Darrell West was pretty blunt about regulation. He doubted governments could really stop AI automation. He felt that technology is just too pervasive, innovations moving too fast for traditional regulations to keep pace effectively.
So government can't stop it. Can it help?
Yes, he argued there's a really critical role government can play, and it's a traditional one, helping with job retraining.
Back to the mismatch problem.
Exactly. He suggested the most constructive thing governments could do is work really closely with local employers. Figure out what specific skills those employers actually need as AI reshapes their businesses, and then fund and design targeted retraining programs to give displaced workers those specific skills. A proactive, localized approach to bridge the gap. That was seen as the most practical and effective government action.
Which links back to that idea of the air pocket you mentioned someone used.
Yeah, that was Stephanie's term, the air pocket. It perfectly describes that tricky phase where AI quickly automates those lower-level, often entry-point jobs.
The first rung on the ladder.
Right. And if those disappear faster than people can be retrained or upskilled for the more complex, human-centric roles that AI can't do, you get this gap, this temporary vacuum or air pocket in the job market structure. It's a really vulnerable point for individuals in the economy during this rapid AI rollout.
Okay, wow. Lots to think about on the AI front. Let's shift gears again from the future of work to something more immediate: cars on the road. You shared a Yahoo Finance piece looking at the auto industry, recent pricing, sales trends. What were the key takeaways from the latest numbers?
Yeah, the main news from May's auto sales was actually pretty positive for some big names. Ford saw a really big jump, something like 16% in sales. Toyota was up around 7%. Hyundai and Kia also had gains.
So good numbers for May. What drove that?
According to the analysis, it was mainly down to automakers and dealers getting more aggressive with price cuts and really working to shed some of their built-up inventory.
Okay, discounts and clearing out stock.
Exactly. And the source suggested that these moves, the price cuts, clearing inventory, seemed to pretty effectively blunt some of the negative hit people were expecting from those auto tariffs President Trump had announced earlier in the spring.
Right, there was a lot of uncertainty then. So was May just seen as like a return to normal after that tariff volatility, or were there other specific things boosting sales?
Kevin Roberts from Car Gurus, who was in the interview, he did describe May as feeling like a return to normal after what he called a crazy time right after the tariffs hit the news in late March, early April.
Okay.
He also pointed out, though, that May is usually a strong month anyway, seasonally. You've got people getting tax refunds maybe, using them for down payments, plus all the Memorial Day sales events.
True, Memorial Day is big for car sales.
Definitely. And beyond the seasonal boost and general price cuts, he mentioned some specific things helping, like Ford running an employee pricing for all deal, which directly tackled that big issue of vehicle affordability.
Makes sense.
And another big factor, hybrid vehicles saw really strong growth in May. And who are the leaders in hybrids? Ford and Toyota. So that specifically helped lift their numbers quite a bit.
Okay. Now, one term that came up or described as the million-dollar question was about pull forward. What does that mean for auto sales, and why is it making people uncertain?
Yeah, pull forward. It's the idea, or the question, really, that maybe some people who were originally planning to buy a car later this year, say in Q3 or Q4, decided to buy it sooner, in Q2, like in May.
Why would they do that?
The main suspected reason would be the tariffs. If people expected tariffs to push car prices up later in the year, they might have thought, okay, I should buy now to lock in a lower price before that happens.
Got it. Get ahead of the price hikes.
Exactly. And the reason it's the million-dollar question and causes uncertainty is nobody knows for sure how much of May's strong sales was actually due to this pull-forward effect.
Because if it was a lot.
Then those sales were essentially just borrowed from the future.
Yeah.
And that could mean sales figures in the third and fourth quarters might look weaker than expected because those buyers are already out of the market. You would bite back, so to speak.
Or maybe the discounts just got people off the fence.
That's the alternative. Maybe the discounts and the fact that the tariff panic died down just convinced people who were kind of thinking about buying, but maybe not immediately, to just go ahead and do it. It's a really key unknown that analysts are trying to figure out to predict how the rest of the year will look for auto sales.
So, with the tariffs now actually in place, even if maybe softened a bit, should we expect car prices to start climbing more noticeably now, like in June or later this year?
Well, the interview suggested that while prices didn't suddenly spike right after the tariffs were announced, a lot of automakers seem to be in wait-and-see mode that's starting to change now.
Yeah.
As we get into June, they're apparently starting to see more of a trickle of announcements from manufacturers about price increases.
So the costs are starting to get passed on.
It seems like it. This is definitely a trend to watch closely because it suggests we might see some actual price inflation on vehicles hitting consumers in the second half of the year as those tariff costs work their way through the system.
There was also a specific mention of General Motors, GM stock, moving lower because of tariff worries. How does that fit in? Especially since there were already tariffs on steel and aluminum. Wasn't there something about not stacking tariffs?
Yeah, this gets a bit complicated with the layers of tariffs. There was apparently an executive order towards the end of April that was supposed to clarify things and basically stop the stacking of different tariffs on the same product.
Okay, no double dipping on tariffs.
Right. For the auto industry, the idea was that the newer Section 232 auto tariffs shouldn't be applied on top of the existing steel and aluminum tariffs for parts that were already covered by those older duties.
So that should protect automakers somewhat.
It does provide some protection, yeah. It avoids hitting certain components or maybe finished vehicles with both sets of tariffs. However, and this is probably the key part, that protection is limited. It only applies to finished vehicles and specific parts already covered by those prior tariffs.
Ah, so other parts might still be hit by the new auto tariffs.
Potentially, yes. Components not covered by the steel and aluminum duties could still face the impact of the Section 232 auto tariffs. So GM stock reacting negatively might reflect worries about the impact on those specific parts in their supply chain, or just broader market jitters about how all this tariff stuff will ultimately shake out for the industry, even with the anti-stacking rule.
Understood. And one last thing on autos. Tesla apparently had some weaker sales in Europe recently. Any thoughts on why that might be, separate from the U.S. market issues?
Yeah, the source mentioned that getting precise, real-time Tesla data is always a bit tough because they sell directly to consumers.
Right, no dealership reporting in the same way.
Exactly. But they did speculate on a few possible reasons for maybe softer European sales. One could be just specific branding issues or consumer preferences varying across the different countries in Europe. Another could be related to the Model Y, maybe some disruption, or people waiting during the changeover to the updated version. And the third factor, which is probably increasingly relevant everywhere, is just more competition. You've got established European brands rolling out more EVs, plus new players entering the market. So it's likely some combination of those things.
Makes sense.
But they did add an interesting counterpoint. Demand for used Teslas in Europe still seems pretty strong. So that suggests there's still solid underlying interest in the brand, even if new sales hit a bit of a soft patch in that region recently.
Okay, switching gears yet again. You also brought in some deep technical analysis from Vincent DiCiano. He apparently called yesterday's trading action awesome. What did he mean by that? What was the big takeaway from his perspective on the market's moves?
Yeah, his main point wasn't just that trades worked out well, but more about recognizing the type of market day it was. He felt yesterday was clearly one of those days with real price action, where moves had followed through, where something changed compared to maybe choppier days before.
Okay, so it was a day with clear direction.
Exactly. And his trading philosophy, as he explained it, is that traders can massively improve their results. He even threw out the number 10x if they learn to identify these high conviction days and only get aggressive then.
And be patient otherwise.
Right. Stay patient, avoid forcing trades or being irrational when the market itself is acting irrational or just stuck sideways. Yesterday for him was a perfect example of a day where having conviction and acting on it paid off.
Gotcha. Did he mention anything else setting the stage?
Yeah, he did flag some key economic data points coming up this week that traders should watch. ADP employment numbers, ISM services PMI today, unemployment claims tomorrow. Plus, big earnings reports from companies like MongoDB, Broadcom, and Lululemon. He also briefly touched on CrowdStrike's earnings miss, noting it pulled back to an interesting technical level around 450 and mentioned their big share buyback plan. And of course, he highlighted NVIDIA becoming the world's most valuable stock, reinforcing his generally bullish long-term view there.
Okay, let's try to unpack some of the technical concepts without getting lost in every single number. He talked about key levels for the NASDAQ and S&P 500 futures. Can you explain the idea behind how he uses these levels? Maybe using an example from the NASDAQ Q and NQ.
Sure. The core concept is identifying specific price levels on the chart that have been important in the past. Places where price clearly reversed, or found strong support, or hit significant resistance. These often represent areas where big institutions might be active.
Okay.
So for the NASDAQ Q futures, the NQ, he pointed to a zone around 21,560, maybe down to 21,530. He called this the perfect launch point yesterday. Why? Because that level had previously acted as resistance. Price tried to get above it and failed.
Right, a ceiling.
Exactly. But then price managed to break through that ceiling. And crucially, when it pulled back later, it held at that same level. It didn't fall back below.
Ah, the ceiling became the floor.
Precisely. That's the classic break and retest pattern. Resistance turns into support. He mentioned seeing clear signs of buying stepping in right there on the shorter-term charts yesterday, confirming that buyers were defending that level. That makes it a significant structural point.
He also used this phrase, the correct move for the market. What did he mean by that? Is he saying the market should go down?
No, not necessarily that it should go down, but that a pullback can be a normal, even healthy part of an uptrend. He called it the correct move. Think about it in a strong uptrend like we've seen. Price rarely goes straight up in a line, right?
It usually pulls back sometime.
Exactly. Moves up, then often pulls back a bit. This can shake out traders who bought late or got scared, allows early buyers to take some profit, and potentially sets up the next leg higher. So he sees a pullback to a significant level that was recently broken, like that 21560, 21530 area for the NASDAQ Q, which was Monday's high, as a correct and healthy development for the trend.
So it's an opportunity for people who missed the first move?
Potentially, yes. It's a chance to enter on a retest of what's now hopefully confirmed support. He really stressed that listeners shouldn't panic just because the market pulls back. If it holds these key structural levels, it's often just a pause or consolidation within the bigger uptrend, not the start of a reversal. This is also why traders watch things like Fibonacci retracement levels in these zones. They measure typical pullback depths.
Oh, okay, that makes sense. How about the S&P 500 futures, the ES? What was a key level or concept he was watching there?
For the S&P, the ES, a key level he mentioned was 5975. This level had previously been a low point, but then later acted as resistance, rejecting price attempts to move higher. He noted price was interacting right around that 5975 level yesterday and today.
So another potential pivot point.
Exactly. And his idea for a correct move, a healthy pullback for the S&P, would be if it breaks back below 5975. If that happens, he thought it might pull back towards Monday's high, which was around 5950 or 5953.
Same concept, break and retest.
Pretty much. The old high around 5953 could potentially become new support. He also mentioned that the ADP economic data that came out today did cause a bit of a downside reaction, maybe starting that pullback towards 5953 he was looking for. So the 5975 is acting as that immediate potential resistance or pivot, and 5933 is the target area for a potential bullish pullback.
Got it. And semiconductors, the SMH ETF, have been just huge drivers. What was the key technical level he pointed out for SMH?
Yeah, for SMH, he felt the plan worked out perfectly yesterday, catching that semiconductor strength. He pinpointed 249 as a really crucial level that SMH must hold today to keep its immediate upward momentum going.
249 is the line in the sand for today.
Seems like it for the very short term. He did acknowledge the recent run-up has been maybe a bit frothy, a bit fast.
Yeah.
So he suggested that even a deeper pullback, maybe all the way back to Monday's highs around 244.40.50, would still be considered a constructive, bullish pullback within the bigger picture trend.
So dip to 244.40 wouldn't necessarily kill the uptrend.
Not in his view, for the larger structure. It might not feel great if you just bought calls, but structurally it could be a healthy retest. On the upside, though, he specifically flagged the level of 252 as likely being heavy with resistance or supply, meaning sellers are probably waiting there. He cautioned against taking big, aggressive long trades right into 252.
Wait for it to break first.
Yeah, or look for signs it can hold above it.
Right.
If it does clearly break and hold above 252, then the next upside targets might be around 255. So for SMH, 249 is immediate support, 252 is key overhead resistance.
Okay. Now, he looked at a bunch of individual stocks, too. We can't cover them all, but maybe pick out just one or two others that had really interesting setups or levels he discussed, maybe something that illustrates a key technical idea or connects to their story.
Sure. Let's grab two that show slightly different things. First, how about Broadcom, AVGO? He was really enthusiastic about this one, called it an unbelievable stock, a behemoth. What was interesting technically was his point that it was the first of the major semiconductor stocks to break out to new all-time highs recently, hitting 256.
Okay, leading the pack.
Right. And he specifically used Broadcom as a perfect example of consolidation leading to expansion, meaning the stock price spent a period moving sideways, kind of building energy. That's the consolidation.
Right.
Before it broke out powerfully to new highs, that's the expansion. It's a classic technical pattern. Sideways action often sets up a big directional move. So now, watching that 256 all-time high level is key. Holding above it confirms the expansion is continuing. Falling back below might signal a pullback or failed breakout.
Got it. Consolidation, then expansion. What's another example?
Let's look at Meta platforms.
Yeah.
Meta. He pointed out that yesterday it was kind of quiet, consolidating, but doing so right above a really significant level around 660 is what he called a fantastic breakout point.
So it broke out above 660 previously.
Exactly. It broke above that major resistance level,
Okay.
and now it's holding above it.
Right.
This shows how a major technical event like breaking resistance can create a new level of support. Old resistance becomes new support.
Oh.
So he viewed a potential pullback to that 660 level, not as a negative, but as a potentially beautiful buying opportunity for anyone who missed the initial breakout. It would be a retest of that important structural level where sellers likely gave up and might now be looking to buy back in.
So two different patterns. Broadcom showing expansion after consolidation, Meta showing a potential pullback to confirm a breakout level as new support.
Exactly. It shows how technical analysis isn't just about lines on a chart, but about understanding the story the price action is telling, where control shifted between buyers and sellers, and where those key battlegrounds might be revisited.
It helps put some structure around all the news and sentiment, grounding it in actual price behavior.
That's a great way to put it. It translates those broader narratives and sector trends into specific, observable price levels and patterns, using market history and behavior to identify zones where reactions are more likely. It's not about predicting the future perfectly, but about having a plan for how to react when price gets to these significant points.
Okay, great context. Now, there was another really interesting deep dive from Yahoo Finance, this time focusing on Qualcomm, a tech giant, been around 40 years. What was their story, and what were the key strategies and bets their CEO, Cristiano Amon, discussed?
Yeah, Qualcomm has such a long and interesting history in communications tech.
Mm-hmm.
Founded by Irwin Jacobs, the name itself means quality communications. Cristiano Amon, the current CEO, actually started there way back in 1995 as an engineer.
Wow, worked his way up.
Totally. And he described Qualcomm's whole journey as constantly fighting against the odds. They had to basically prove that revolutionary wireless techs like CDMA even worked back in the day. Sometimes they had to build their own phones, their own infrastructure, just to show it was viable.
So a history of disruption.
Definitely. That history created this culture of, as he put it, reinventing ourselves. They were pioneers in mobile chips with Snapdragon, and they've pushed beyond just phones into automotive, into PCs. He gave this really cool example of their quality claim.
Yeah.
The little Ingenuity helicopter flying around on Mars, it runs on the exact same Snapdragon chip you find in regular consumer smartphones.
No way. The same chip.
The exact same one. Shows how robust their tech is, working in those extreme conditions. For Iman himself, leading the company now, he said it feels surreal, but also carries this huge weight of responsibility to the employees.
So you mentioned they're reinventing themselves, diversifying. Where are they pushing now? What are the new growth areas beyond their traditional smartphone chip business?
That's really the core of their strategy right now. Diversification, moving beyond handsets. A huge new focus is the data center market. Amon called it a massive opportunity. Said the potential market size, the TAM, is set to grow for decades.
Data centers, like cloud computing, AI infrastructure.
Exactly. They believe they have genuinely unique and disruptive technology for that space. They're confident they can build, in his words, one of the world's best CPUs, specifically for data centers.
Ambitious goal.
Very. And this whole diversification push was really highlighted by a recent trip the CEO took to Saudi Arabia. It resulted in several